Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of the current ratio, also known as a working capital ratio. The current ratio is a measure of liquidity and is most widely used to make the analysis for short-term financial position or liquidity. Current ratio is calculated by dividing the total of the current assets by the total of the current liabilities, and both of these can be found on the balance sheet of the companies you're interested in. The current ratio, as you can see here, is simply the current ratio, the current assets divided by the current liabilities. Current assets could include cash and those assets which can be easily converted into cash within a 12-month period. These items can include securities or marketable securities, accounts receivables, inventories, work in progress, prepaid expenses, etc. The thing you should note about this is that these items can be subject to some some variables as far as, like for example, marketable securities. Just because you have them on your books doesn't necessarily mean that if you went to sell them, that when you needed cash, that you'd be able to get what you think they're worth. The same goes for accounts receivable. Just because you have people on your books that owe you money doesn't necessarily mean that they're going to be able to pay you when you need it. Inventories, the same thing goes with inventories as far as, can you really sell everything in your inventory at the prices you have it on the books for? Work in progress, if you complete some project, doesn't necessarily mean that the company you worked for is going to be able to pay you immediately. So there are some issues regarding current assets and current liabilities that you need to comprehend, which are, maybe you've got a really nice current ratio, but what's the quality of that ratio? Is it really as liquid as you think it is? So you're only going to know that by actually going into the company's balance sheet, actually analyzing what their current assets are and what their current liabilities are. The current liabilities can include outstanding expenses, accounts payable, accrued expenses, short-term advances, income tax payable, dividend payable, etc., etc. And those can also be more difficult to pinpoint the exact amount that they're worth and the exact ability to pay them on the exact moment in time that you may need to. So it's important to think about the quality of the current ratio as well as the current ratio in relation to what it's telling you. Let me show you a quick example here. Okay, here we are looking at Corning, ticker symbol's GLW, and I'm on the Yahoo Finance page, on the key statistics page, and you can see that they have the current ratio listed right here, and you can see right now it's a 4.14. All right, what is that? Well, a 2 is considered good. All right, so Benjamin Graham would actually require a 2 on his analysis. Whenever he looked at that, he wanted to know that the company had enough money on hand to pay their expenses or the current liabilities for a year, not once but twice, and that was his basic little acid test that he would give. If it falls below 1, if your current ratio is below 1, then you're basically looking at a situation where you have a negative working capital, and that's not a strong position for a company to be in. There's some that would argue that a high number like this one, we've got 4, if they were to see 4, 5, 6, they would say, okay, the company is not being efficient with their cash. They've got just too much. That could be debated either way, and you really need to analyze the company and read your the information your company puts out to determine whether or not they're going to be using that effectively or not. For example, let's say that you own a company and you want to buy another company. Well, you're going to need cash to do that, so you start building up your cash. Well, then that would start increasing your current ratio, wouldn't it? So there's something else to think about. Also, if you want to do a buy back your own stock, you're going to need more cash, so your current ratio would start to tick up again. So just because you have a higher current ratio doesn't necessarily mean a negative. It could be that the company is mismanaging, or maybe they're just preparing to manage even better. So take that into account. One more item that you need to know about the current ratio is compare it quarter to quarter and see what change, if any, you're seeing. Not minor changes, but any major changes. If all of a sudden your company is deteriorating and you're seeing the current ratio fall from 4 to 2, what happened to all that money? Or if you see it tick up really big, did they just take on a whole bunch of debt and that explains why you saw this increase of cash, or what's going on? So these are things that you should pay attention to. If you've not been to our website at perfectstockalert.com, it's right there. It's 100% free. All we ask in return, please refer a friend. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.